Ever wondered what a momentum machine looks like in the stock market? Today, we are diving into a strategic analysis of KPI GREEN Energy following their massive Q3 FY26 results. This is a deep dive into why this company is being called a momentum machine in the renewable energy sector. The Q3 scorecard shows unstoppable growth across every major metric. Revenue is up 45% year-over-year at 676 crore, while EBITDA surged an incredible 73% to 251 crore. With a massive 3.61 gigawatt order book, the revenue visibility for the future is crystal clear. The real story here is operational leverage in action. If you look at the charts, you'll see that profit is actually outpacing sales. Because the EBITDA growth of 73% is so much higher than the 45% revenue growth, it proves that scale benefits are driving the bottom line faster than the top line. Margins are on the rise, hitting new record highs. The EBITDA margin has jumped to 37.1%, which is a significant 600 basis point increase from the previous year. Despite facing higher finance costs, the company's operational efficiency has allowed them to deliver their 7th consecutive quarter of highest ever revenue. The revenue mix is a strategic balance between immediate cash flow and long-term asset building. The captive power producer segment, or CPP, is the cash engine, contributing 91% of revenue at 606 crore. Meanwhile, the independent power producer segment is the wealth builder, focusing on long-term asset ownership with over 519 megawatts already installed. The future looks incredibly bright with a 3.61 gigawatt pipeline. This isn't just a short-term quarterly pop. This backlog secures growth and revenue for the next 2 to 3 years. When you combine current installations with work in progress, their cumulative portfolio stands at an impressive 4.74 gigawatts. KPI GREEN Energy is evolving beyond just solar power. They are future-proofing the business by entering the green hydrogen sector with a 1-ton per day plant and securing a massive 445 megawatt battery storage order. These next-gen energy solutions represent a shift into higher margin technology. Let's talk about the price of all this growth: the debt. Total debt has risen to 4,136 crore, bringing the debt-to-equity ratio to 1.50. However, the critical insight here is that this is good debt. It is being used to build long-term annuity-generating infrastructure that earns 3.16 rupees per unit. The company has massive institutional backing to fund its expansion. The State Bank of India has sanctioned 3,200 crore, the highest in the group's history, alongside a 670 crore green bond issuance. With a strong current ratio of 2.92, the growth is fully funded by top-tier institutions. Execution remains efficient despite the heavy capital expenditure. Inventory turnover stands at 183 days and debtors turnover at 121 days. Most importantly, they maintain a strong ability to service their debt with an interest coverage ratio of 5.19 times. Of course, there are risks to watch closely. Rising leverage requires flawless execution to manage repayments, and finance costs have tripled to 49 crore, making them sensitive to interest rates. They also face complex execution challenges in difficult terrains like Kavda and floating solar projects. The final verdict is constructive. This is a high-growth momentum play transitioning into a green energy giant. The bull case is supported by a record backlog and margin expansion, while the bear caution reminds us to monitor debt levels and execution speed at the Kavda site. If you want more smart investing insights like this, make sure to subscribe ZinvestZ. Remember, investing involves risk, and this analysis is for educational purposes only, so always do your own research. Thank you.